Good day, everyone.
And welcome to this session on hybrid funds.
My name is Harshad Borauke, and I work as a fund manager at Mirae Asset Mutual Fund. Studies suggest that asset allocation is more important than timing the markets. Hybrid funds gives diversification across asset classes. Allocation between the assets is based on internal framework, which in turn is also based on fundamentals as well as relative valuation. Rebalancing, on the other hand, is done on autopilot across cycles, and investors don't have to bother about the timing the market. Net, I would say it gives diversification across asset classes, participation in the equity markets, and data allocation gives downside protection and also lowers the volatility. Now, coming to aggressive hybrid fund. So, as you see, for the hybrid funds, returns are based on two factors. One, what is the asset allocation, and second, I would say what we buy within the equity portfolios. As the name suggests, aggressive hybrid positioning is on the higher equity side. So if you look at our own history, we have been maintaining equity percentage in the range of between 65% to 75% depending on valuations. Taxation for the fund is equity taxation. The equity portion for this portfolio is kind of a flexi cap, in the sense we can buy across the market capitalization. However, given the investor profile who typically comes to these funds, we have been maintaining this large cap biased. Equity portion is built on bottom up basis, while we do keep the cognizance of the benchmark. Our style is more of a buy quality name and up to a reasonable valuation. So if you look at portfolio changes in the last 2 to 3 months, so we have marginally increased equity percentage to around 77%. Our key overweight sectors include financials, within that banks, capital markets, auto, aviation and pharma, and also telecom and utilities. We also have a decent weight on the consumption as a theme, but X of FMCG. Consumption for us includes building materials, consumer durables as well as retail, while underweight sectors are more like capital goods, FMCG, insurance. Key changes, if you ask me, over the last 3 months, we have added some weight in chemicals, banks, and cut some underweight in FMCG. Exited REIT primarily in the view of better yields on the debt side. We also cut some weights on the auto and within banks did some rejigging of the weights. We are largely underweight in global driven sectors like metals and oil and gas. Thank you for joining us. Have a good day. For more updates, you can join our social media channels.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.